All right. So I'm going to in a short period deal with all the 4 standards that we proposed. All right. You have the opportunity to watch the pre-recorded video, even as we discuss this. Now, for every standard, I define. So we'll talk about definition. For every standard, there is a recognition criteria. And the recognition criteria is very useful in your exams. Then we will talk about measurement. Then under the measurement, we take time and deal with the initial measurement. And we will also take time and deal with the subsequent measurement. And in trying to understand the subsequent measurement, you have to go through and deal with issues like depreciation. We'll deal with issues like useful life. You'll deal with issues like revaluation. And lastly, we will talk about disposal, how we treat disposal of PPEs. Then disclosures. So these are what we're going to do. That is how we are going to approach the level 2 standards. All right, so what is the definition of a PPE? PPE is an asset. And please, from conceptual framework, you should have the definition of an asset. All right. The definition of an asset is any economic resource controlled by an entity because of past events or as a result of past events. That is the definition for an asset. It used to be in 2010 conceptual framework when they defined it as an economic resource controlled by an entity because of past events, which result in economic benefit flowing to the business or to the entity. But in 2018 conceptual framework, that aspect of it was chopped off. So they define an asset as an economic resource controlled by an entity because of past events. And the word control in the definition was open up to mean that if you control it, then the economic benefit will flow to you. So the economic benefit is generated because will come to you because of the control that you have in the asset. So that is how they did the new definition. And so when we say a PPE is an asset, what do we mean by that? It is an economic resource controlled by an entity because of past event. The past event is always the exchange of cash and cash equivalent for the assets, all right, or a transfer of liability. Okay, so those are the past events. Now, PP is an asset that is used, and the usage is for the production of goods and services. for rentals and for administrative purposes. All right, and it says that it usually can be used for a period of 12 months. Sorry, over 12 months. As for this aspect, it is the one we've known from senior high school. All right. If you ask a senior high school student, what is an asset? He'll tell you that something that can be used for more than 1 year period. All right. So that is that. Now, then the recognition criteria, every asset has 2 basic recognition criteria. Please, who can tell me one? This is revision, level 2 revision. So if you have ever done it, I just want to give you the opportunity to, recap some of the things. Yes, anyone? Yes, please.
There should be probable that future economic benefits will flow into the entity.
All right. So.
And then cost. And then the cost of the asset must be measured reliably.
All right. Thank you. So probable inflow of economic benefit. Then we have reliable measurement of cost. So you see, these 2 things are what the basis what you base on to say something is an asset, a PPE. All right. Okay. Now, the initial measurement. All right. The initial measurement is at cost. Initial measurement of PPE is at cost. And when we say cost, cost has 3 components. One is the purchase price minus discount. And refundable taxes. All right, I'm going to ask practical questions here. Discount. There are 2 types of discount. Yes, who remembers? What are they?
Trade discount.
Trade discount.
Cash discount.
Cash discount. Which of the discounts applies to what we are talking about here? What is the difference between a trade discount and a cash discount? Yes.
Cash discount is when you pay earlier.
When you pay earlier, early settlement. And the trade
is paid at the point of you buying the asset.
At the point of purchase.
Yeah.
So which of these 2 discounts do you think relates to what we say you can less? The one we will less. Which of these 2 discounts? Please, this one means less, minus. Which of these 2 discounts do you think is applicable here?
Trade discount.
Trade discount. So trade discount is what we are talking about. As a matter of fact, the cash discount is computed on the amount that you owe, all right, which you are settling early. Now, so therefore, the cash discount will be applied on the purchase price minus the trade discount. Okay, minus the trade discount. Cash discount is applied on the purchase price minus the trade discount. So this one affects the cost of the product. Of course, if I'm going to buy something and they say it is 10,000, and they said, oh, okay, at the point of purchase, we agree and we let's say by 2,000, therefore I'm paying 8,000. The 8,000 is the value, all right, that is leaving me. And therefore, if I settle that 8,000 early and I get a discount, that one will be the cash discount. And so cash discount is treated in the P&L. If you remember, in your senior high school level, you were made to prepare a 3-column cash book where the cash discount forms part of the 3rd column, which is always treated in your P&L as other income. So that is where, if you remember, that is how it started for you. Now, so please always take the trade discount. Cash discount does not form part. You don't reduce your liability of the cost of the asset by the cash discount. Please take note of that because we will meet it shortly. All right. Now, another thing is that we said the cash discount is treated in the P&L. Right. Let's come to the refundable taxes. What are some of the refundable taxes you know in Ghana? A tax that you pay, you receive it back. Yes. Yes. Those of you who buy stuff, when you have VAT, don't you do VAT input and VAT output to claim back your VAT? Yes. Is that not true? Please let me hear some response. Let's make it as practical as it can be so that you can relate to it. Hello?
It's true.
Yeah. So
Which one I said?
yes. So if you check our Ghana laws, if you would not, if capital allowance, you see what we do in Ghana is that if you buy something, then it has VAT, an asset that it has VAT as part of the value, then that particular VAT on that asset, you cannot claim it. You cannot do input output on that asset. Why? Because you have added that VAT as part of the cost of the asset in your books. And capital allowance will be given with the VAT inclusive. So you cannot go back and claim that VAT again. So that is the relationship. If you didn't add it to the cost of the asset and treated it separately, you can claim that aspect. You can do VAT input output for that side. But if the VAT is inside the cost of the asset for which you are going to get capital allowance for, then you cannot do input output for that VAT. So please, that is it. That is the situation. But we all know that sometimes, I'm sorry to say, our GRA people don't really check some of these things. Some do. I have seen some who do, but some of them too, they've probably not gone through the ICA system, and therefore understanding of these things becomes.
Seton,
yes, please.
please, with the refundable, please, can you rewind it again?
Oh, any tax that you pay that you collect it back. You see, you paid it, you collect it back. So why should we allow you to add it to the cost of your asset? Something that you collected it back. How is it a cost to you? Please, are you getting it? So I use VAT as an example. In VAT in Ghana here, you always do VAT input and VAT output to claim back, to claim back the VAT that you paid on something. So why should we allow you to add that VAT, especially those of us in retail tradings and stuff. Why should you be allowed to add that VAT to the cost of the asset when you do VAT output to collect the input back? Please, are you getting my point?
And you made mention of when it is embedded in.
Yes, when it is in the cost of the asset. You know, you claim capital allowance on the asset. So the VAT is part. So why should you now then be allowed to claim a VAT of which you are getting a capital allowance on? So it's two sides. If you did not add it to the cost of the asset, you can do input output to claim it back. And that is what we are talking about here. It is separated from the cost minus, all right, minus discount. So you can do minus discount plus this. All right, so into bracket. So you add those ones that you are lessing from the purchase price. So if the VAT is inside, why should we allow you to claim capital allowance? Sorry, if the VAT is not inside, why should we allow you to claim capital allowance on something that you do input and output to collect it back from? So the whole idea is that something that you get back should not be part of the cost of the asset. You will be cheating. All right. I think I've broken it down for you to get it. But if it's not, let me still get a question.
Yeah, sir, I want a clarification.
Yes.
So it means that if you have the price of the item and you are entitled to capital allowance and the VAT refundable input is inside, you take the VAT input out first before you apply for the capital allowance.
No, it's not your job to do that. It is your job to decide whether I'm adding the VAT to the cost of the item, because when you are paying the client, you will be paying the VAT. The supplier, won't you?
Exam situation where they embedded it to expect you
No.
to cover them.
This crowd, I've never seen it examined in this thing before. I've checked through all this thing. But in case in an exams, it means you have to deduct it. All right, just as we are saying, deduct it here. All right, this is the IAS 16. This is not, we are not doing taxation, we are doing financial reporting or corporate reporting. And this is what the standard says we should do. So that is exactly what we will do. Please, are you getting it?
Thank you, sir.
Yeah, so in corporate reporting, please take off the discount. It is a the refundable taxes, take it off. When you go to your taxation lecturer and he tells you do same, fine, because he may have the scheme of how things are being examined there. Even though I'm a CIT graduate and I teach tax too, I would say that what you do is that if you pay it to the customer, then you pay. But you can't claim that VAT for which you'll be receiving capital allowance on in your input and output analysis. That is all I'm saying. Because if you add it to the cost to claim capital allowance and at the same time go and collect the input output, you receive it back, you are cheating. You have added to the cost of the asset something that you collected back, and money that you collected back. So you are cheating. So that is that. That is in the eyes of tax, but here is corporate reporting. All right. So number 2, you add direct costs. Okay, so the direct cost, we are talking about any other cost incurred into bringing the asset into its useful state as intended by management. Please listen carefully because these are standards and standards are law. So if you don't apply the law, unless mercy, unless you have, in fact, unless, because if you miss the law, unless you are the mercy of the judge. Yes, because, and this is exams. If you meet the law, you are wrong. In fact, even if somebody passes you, the person is sinning because you did not do the right thing and you are being marked right. So please listen carefully and we will be applying the laws in terms of figures. So we are saying that direct costs are costs that are what incurred into bringing the asset to a state or useful or saleable state. As intended by management. These are the amendments in the standard intended by management. They are the amendments in the standard. So, for example, if I want to price my phone, find the cost of my phone I went to Circle to buy, it will be the purchase price. If the guy gave me a discount, I need to take it off. All right. As for an individual, hardly do you do input and output. So the VAT and everything you pay will be in there. You have to, I mean, it's not refundable, so it will be in there. Then we have direct cost. The cost is my transportation that I used to go to Circle to buy the phone. So remember in your senior high school level, you do something like opening cost, opening stock, add purchases, then you add what? Carriage inwards. If you remember those things, you added that because it is part of the cost of bringing the thing into each useful or saleable state. And now they've added as intended by management. The word intended by management came in because of something the standard wants to do. We call it a self-constructed asset. Constructed asset. Now, what the standard proposes or the standard is telling us is that if you are constructing an asset, let me say, okay, I'm constructing a school building. The purpose of the building is to use for school. So that is the intention of management. So I'll buy a land, and what do you do? You do your foundation and you'll do your building and also all these things. Now, the standard is saying that if at a point in time, for example, you bought the land and you felt like, oh, you are not about starting the building as soon as possible, and therefore you want to use the land that you have bought to do some small business. So something like a car park business, all right? So for a while before you start building, so you go and buy sand and level the ground and you use the land for a car park. My question to you is that, will the cost you incur in leveling the ground be part of the cost of the assets? That is the question. Is there any opinion? Because at the end of the day, you will still come
I say yes, because
okay,
even if we are building the school, you still level the ground.
You still level the
Or
ground.
car park, yeah.
All right.
But the parent will bring their children to school.
Okay, that's nice. And it is the exact reason why the standard brought in this issue. Because the standard is saying that the cost you incurred in leveling the ground was for the purpose of a car park. That is why you did the leveling of the ground. And so therefore the cost here should not be part of the cost of the asset. However, when you do the car park, you see you get revenue. When you do the car park, people will come and park, you charge, all right? Or a washing bay, people will come and you charge. And so therefore, the cost that you also incur should be matched with this revenue and treated aside in the P&L as an other activity income or other income. Please, are you getting it? Because if you say we should charge the cost to the asset, where would we charge the revenue? Also, it's also coming from the same car park. All right, the leveling that you did. So that is why the standards are added the as intended by management. The intention of management is to build for a school. So anything aside the school must be treated what? Separately. That is what the standard has brought in. Please, is that okay?
Sir.
Yes, please. Please, if you have questions, you are allowed to ask. I need your responses to know that what I'm doing is sinking so that I can move on. Yes, please. Any question? All right. So please, this is something the standard has brought in. You need to take care of it. All right. And it's something that, yes, please.
I have a question. Assuming, sorry to bring you back to the refundable taxes. Assuming we have non-refundable taxes, how will you also treat it?
Oh, you see, we said refundable taxes. So if you have non-refundable taxes, then it's part of the price of what you pay for. You won't deduct it.
You rather add that one back.
Yes, it will be part of the, already it is added back. It is already inside here. That is why you are taking it off. If it is not inside, then fine. You see, nobody will give you an invoice in Ghana situation, for example, without a VAT. It's not possible. In fact, as our law opines, if you are a company and you buy from a non-VAT person, that expense will be disallowed for tax purposes. Didn't you see the communique that came that prove your expense with your VAT invoice? Yeah, last year it came out. Prove your expense with your VAT invoice. And there was this issue of what if the person that I bought for by law is not supposed to register for VAT? How can you tell me that I should prove it, prove my invoice, my expenses with my VAT invoice? When the law gives clearly from section 6 to section 16 of the VAT Act 870 that there are, especially section 6, there are criteria for you to register for VAT. If the person doesn't fall within and he didn't register for VAT, and I've also conducted service from that person, how can you now tell me that I should prove my expenses with my VAT? Because the person actually, by law, is not supposed to register for VAT compulsorily. So that is that. So you will always have the invoice that has a VAT. The question is that, are you going to let it be there or you deduct it? If so, the taxes will be there. So you ask yourself, the taxes that is already in the cost invoice that you are receiving, is it refundable or is not refundable? And I'm telling you that in Ghana case, all you need to do is to treat the whole amount of the invoice as the asset amount. If you do that, you cannot do input output for that VAT to claim it back. I don't know if I still make sense.
Yes.
Yeah, so that is all that I'm saying. If you want me to show it in figures, what I'm saying is that I bought something 10,000, which had a VAT inclusive amount that made it like this, 12,000. And this is an asset. I will treat this 12,000 that I'm paying as the asset value and therefore receive capital allowance on this. But this 2,000, I cannot go back to GRA and say I'm claiming back the 2,000 Why? Because you have already included in the cost of the asset for which you are getting capital allowance. But if you will do that, that is where we are saying that if you go and claim this 2,000 back, why should you be allowed to be claiming capital allowance on something you didn't spend? That's all I'm saying. Because you collected it back in the form of VAT input and VAT output.
Okay.
Yes, but how many of our people probably have gone through, because you are an accountant, and as at the time you are preparing your account, you always include the VAT in its natural setting. That is how it is done. You always include it. But when you are filing for your VAT return, you cannot claim it back because you are getting capital allowance on it. So your claiming back will be in the form of the capital allowance you are getting. Yes. So it makes the whole class go into tax. But please let me stay in my corporate report. All right. So that is that. So please take note of this thing that we have done here over here too. All right. So I asked the question in my class that Alisa Hotel is very close to where I teach in Tema. And I asked them the utensils and the utensils that they use in the hotel, does it befit this definition of an asset? 12, more than 12 months used for production of goods and services, rental, administration. Does it befit the definition of an asset? Yes.
Sir Tom,
Yes, please.
can we consider those items as loose tools?
Okay.
Yeah.
It's been a while
Because,
I heard that language. That was when I was in senior high school.
Exactly, because
where we use
they
pins.
Yeah.
As
They look so difficult to be added as capital assets or revenue something. You understand?
Yeah, I do. But you see, the standard here tells us that given their value, if you bought them in bulk and you have their value, it won't be a lose to. Go to a Lista Hotel or what do you call it, Kempinski and those places. Ask them, because they don't go and buy it from the shop one by one. They buy it in bulk, and so the value is cumulatively in bulk.
And so purchase, we just consider it under purchase.
As inventory?
Yes.
But does it befit the definition of an inventory?
It will be used for more than 1 year.
So that is the problem. So all those things are now classified into an asset. They are assets. So depending on the value, like you said, yes. So take note of that. I know these things won't be examined in your exam like that, but since you are professionals and you are working in various places, you may go to an interview in this hotel and they will ask you, how do you intend to think? You have to give them what the standard says, because you are going there as an accountant. So you have to understand how some of these things are. All right. So please, that is that. And so therefore, we've talked about self-constructed assets. And so what I'm going to do now is to quickly give you some lines of expense that are considered direct expenses. You know them. Some of them are like the legal fees, engineers fees, the architecture fees, what we call pre-testing. And that testing is part of the cost of the asset, testing the asset. So please, that reminds me. Let me say this. When we talk about the asset, our intention is the asset. We are talking about valuing an asset to asset. And we are talking about the asset being made ready for use, the asset. The asset is ready for use. The fact that you don't use it doesn't mean it is not made ready for use. Please know that. And number two, sometimes they trick you with staff. They are training the staff to handle the assets. Please, we are talking about the assets, not the staff, not the human being. What we are talking about is the object, the asset. Because I've seen it time and time. They trick students about direct cost. They said, oh, the asset is new and therefore they will have to train the staff to come and use the asset. Please, the thing is already in its useful state. You are now going to acquire the knowledge to come and use it. That knowledge doesn't affect the functionality of the asset. The asset is already functional. You, the human being, is the one going to learn your trade of how to use the asset. It has nothing to do with the cost of the asset. Please, the focus is the asset, the plant, if it is a plant, the plant. If you are now going to learn how to come and use the plant, it doesn't mean that the asset is not having its useful or sellable state. It is already useful. You are now going to learn how to come and use it. So please, those things that they want to trick students with and all those things, the focus is on the asset. All right. So please take note of that. Take note of that. Any question? So please, that is what we are. So examples of direct asset cost are what we said, the professional expenses. So the professional, I'm talking about the legal, the accountants, surveyors, engineers, all right, pre-testing costs, and all those things. Any cost that is so direct that if you don't incur it, the thing will not come to its useful state as intended by management. All right. So that is that. So once the asset is made useful, any other expense that you do from there is no more a cost of the asset. Example is the staff training, sales losses, repairs and maintenance, and all those abnormal losses. All those things are not part of the cost of the asset. And so those things that are not part, you expense them immediately. We are not saying throw the costs away or the expenses away. All we are saying is that it won't form part of the cost of the asset. Treat them as an expense. All right. And sometimes you see that they will give you labor. Labor is a direct cost if you are building. All right. But sometimes they will tell you that the labor went on strike. Okay. The part of the money that you don't pay the labor because they went on strike shouldn't be part of the cost of the asset because they were not working. If you have materials, what you are using to produce, let's say cement, and some of the cement gets destroyed, you didn't use the cement as part of the construction of the asset. So that one too can't be part of the cost of the asset. It's an abnormal loss. You made it spoil. It's like saying I pay penalty, and penalty should be part of the taxes that I should pay on a specific year of assessment. It is a penalty. You didn't do your things well and you were charged a penalty. You can now come back and say it is part of the taxes that you are supposed to pay. So please, that is that. And some other expenses like demorages that were under your control. So all those things are supposed to be part of cost. That is why we have cost of sales for and other things for those things. All right, so that is that. Then the last thing about the cost of the asset is the PV of future dismantling cost. I know you've heard about it before, future dismantling cost. And these things are mostly for those who work on minings and what do you call it, oil fields and all those things. Now, what it is that in future, you have to restore the land back into its usable state as you met it. Now, and so therefore, since the value is in future, you need to PV it to the present. And so the formula for PV so you need the amount, all right, and you multiply it by the discount factor. So we say this one is the future amount. So you can do PV is equal to future amount over 1 plus R raised to the power N, all right? N is the number of years it will take you to pay that future amount, all right? R is the discount factor, the rate. This is the future value, the future amount, and this is the present value you are looking for, all right? So that is that. Or the formula can also be stated as future value multiplied by 1 plus R raised to the power minus N, all right? So whichever one that you do, this part is the discounting, all right? This part is the discounting. Okay, so you discount it back. And so I'm going to give you an exercise now. Please, everybody should PV. Let me see if you have the PV 10,000. To be paid in 5 years' time. Cost of capital is 10%. Please, everybody should do that now for me. Please, you have just 2 minutes. Use your calculator, do it, because this is something you'll be facing. I want to see if you have the practice of it. $209. Please, those of you who are practicing, make sure that your answer gets to now this figure. So this is the figure in 5 years' time. All right, in current year, sorry. In 5 years' time, it is 10,000. All right, so my question to you will be that, what will happen to the difference between 10,000 and the 6.2, which is, the difference is like 3790 or 91.
Hey, morning, Mrs. Mpume. And then now I'm saying I'm busy, kakra.
All right. So that is what you have. All right. Now, so you have year 0, year 1, year 2, year 3, year 4, year 5. Okay. All right. Let me put year 5 over here. In year 5, the value is 10,000. In year 0 here, it is 6209. That is what you've done. What will be the values over here? And the differences in those values year on year is called unwinding finance cost. And you need that anytime you do a PV, you need to unwind the finance cost 1 year and treat it as a P&L item. All right. So anytime you do that, you need to unwind the finance cost as a P&L item. So please, I tell my student that each time in reporting, each time you see a PV of a value, there is a corresponding unwinding finance cost you have to treat. I don't know, those of you who have gone through the consolidation with Prof, you see it is there. If the purchase consideration is deferred and you PV it, there is an unwinding. And that unwinding is always treated as part of the workings 5 group retained earnings, because it is a P&L item, and that is the representation of a P&L in consult balance sheet. All right, so take note of that. So what you would do is that the rate is 10%. So every year you unwind 10%. So what do you do? This year, the value of this in year 1 time will be the 10%, which is 1.1. 1 plus R, which is 1.1, multiplied by 6209. And so you will get what? 6820 6830. So the difference between here to here is what we call the unwinding cost. So if you do that, you have something like how much? Please help me with the figures. Fast.
6830.
It's what? Yeah, I've had that. I want the difference.
Okay.
I have 620.9.
621.
621. So you round it up. Yes. 621. So that 621 will become the unwinding, which will be treated in the P&L. All right. So then you do 10%. So when you do it at the end of this point, when you do it correctly, you should have your fifth year to be equal to the 10,000 exactly. So if you go on, you have 6830. You do another 1.1. You have what? I have something like 57513. So the difference between here and here, if I'm standing in this year, that difference will be an unwinding. Then you continue to do multiply by 1.1 again. In the third year, I'm having something like 8264 in the 0.3. In the fourth year, 1.1. I'll be having 1990.73. Then I do for the last one. You see that I get 10,000. If you don't get 10,000, you get 999.99999. So it will be 10,000. So that is what we mean. So the differences in these value year on year is what we call unwinding. So if you are preparing the account in this particular year, your unwinding will be the difference over here, year 1 and year 2. If you are preparing your account in this year, your unwinding will be here. If you are preparing the account in this year, your unwinding will be here. So please, that is what we are doing. That is what we are doing. All right. So please, I need you to understand how these things work. All right. So that is that. That is that. Let me move on. I'm taking my time. Normally, I do PPE using one meeting because every other thing you will be doing from henceforth will be based on this knowledge of PPE. So I don't mind we doing the PPE for today. What you will do for me is to go back to your pages. The other standards are there. Please, if you have time today, go over what we will do today and watch the other videos, the IAS 20, 23, and 40, so that instead of me teaching it again, God willing, tomorrow, we'll rather be solving the past questions. It's just a 2-hour lecture. All right. So spend a 2 hour in today to kindly go through that for me, so that we will actually be solving the questions rather tomorrow evening. All right, because these days I'll have to close exactly 7 o'clock so that I can meet the other people as the India.
Tom,
yes, please.
I don't think there's.
Please, that is that. But I hope you understand the concept of
the discount values.
You said what?
You see, the values, the same as the discount values, the 10% values.
Yeah. The unwindings.
Yeah.
But you see, the 10% has to be calculated on the figures, not the initial 10,000.
Yes.
Yes, the figures that you have. All right, they are the same. Of course, it is the 10% that you'll be computing. All right. So please, any question? Because I'll do a small quick test on this one. You have the time for, I'm sure. All right. So please don't forget to always treat those things in the P&L. To get that tick too is very important. Every one tick is important. All right. So that is how you deal with the cost. All right. Let's now come to the subsequent measurement. Now, the subsequent measurement brings in some concepts. So the subsequent measurement, the standard says we have two models for the subsequent measurement. We have the cost model and we have the revaluation model. So the revaluation model will bring in the concept of revaluation. We will look at it, and we have the cost model that is bringing in the concept of depreciation and useful life. So in between this, let's talk about the first one, depreciation. Please, what is depreciation? You have to know the definition for interview purposes. Cost model is saying that you will need the initial cost, you will less any accumulated depreciation or any accumulated impairment. So you less them. Then the current year depreciation and current year impairment. Okay. Then you get what? Carrying amount. This is what we used to call net book value. It's called carrying amount. All right. So that is what you have. And this one now becomes your subsequent. And therefore, this one, your subsequent measurements. So this value will go to the SOFP balance sheet, and this value will go to a P&L. All right. So what is depreciation? Yes. What is depreciation? These are knowledge you need to know, because I've had the opportunity to interview people for officers in firms that I used to work with. If you come, my first question to you will be, what is depreciation? Because
Okay.
it will be something yes, please.
Depreciation is a systematic allocation of the cost of an asset over its useful life.
All right, that is fine. That is fine, except that you have to replace the cost with the carrying amount. All right, the carrying amount. If you want the standard definition, is the systematic allocation of the carrying amount of an asset over its useful life. Sometimes the carrying amount is equal to the cost. But if you make it the cost, it means that if you are in the second year and you still amortize, you still use the cost over the remaining useful life, it will be a problem. You will see in some of the examples that we'll be doing why the standard did not use the cost for the definition. The cost will just be for the very first year. All right, so that is that. So the systematic allocation of the carrying amount of an asset over its useful life. That is Babadier definition. All right. And you have to understand, I mean, we are spreading the value of an asset over the useful life. That's what we are doing. All right. Okay. Then I'll ask you again, what is amortization? So please, I'll ask you when we get to IAS 30, what we call IAS 38, I'll ask you what an amortization is so you can read ahead. Now, the standard give recognition to only 3 methods of depreciation. We talk about the straight line method, and I know you know the straight line method. The straight line method is saying you need the cost minus scrap value all over what? Useful life. Please, when we give you these formulas, this is what we will be applying in the computational. So you have to get the formula on your fingers, because if you don't get it, when we get to the computation, it will be something alien for you. So please get it from here. All right. And the standard also give recognition to reducing balance. And the reducing balance, you have to calculate a percentage on the carrying amount. All right. What is the carrying amount? That is what you see here. The cost that you have less these things. So that is what you do. So sometimes you will not get this because this is what you are looking for, the current year depreciation. That is what you are looking for. And therefore you have to take the cost less the accumulated depreciation before you can multiply it by your percentage. So 20% means 5 years, all right? And so here is the same. When they give you 20%, it means 5 years. When they give you 2%, it is 50 years. So, I mean, work your way around it. The standard also mentions machine hours. If it is a machine, so that one, you need the hours used all over the total hours. Okay, the hours used all over the total hours, multiplied by the amount. Okay, so that is that. So that is how you get depreciation. And so this is the depreciation we are talking about here. That is how you get it. All right. So what we need to know is the useful life. You all know the useful life is the time the asset will take. All right, the time the asset will take. All right, so that is that. So this one helps us to do with this cost model. All right, then let's come to the revaluation model. We will talk about what we call revaluation.
Of course.
Yes, sir.
What about other methods of depreciation?
It is not giving recognition in the standard. I know there are other methods that those ones are not giving recognition in the standard.
Thank you.
So in senior high school, we did like 7, right? Some of you had the gate and all those things. I mean, the standard give recognition to these ones. All right. Just like we were, when we were doing costing, we had FIFO, LIFO, standard, blah, 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 all those things. When you come to reporting, it gives recognition to just 2. Weighted average and FIFO. It doesn't even give recognition to LIFO. Okay, so please, that is that. So the revaluation, you see, an asset can be revalued, all right? It can be revalued. So those of you who did audit with me, I told you that is where we call valuation, all right? So revaluation, you know the value already, but you are valuing it again. And usually it is at the recoverable amount. We want to see how much when we sell the asset, we will get, all right? Those of you doing public sector is the same thing. There's a standard for that, the same thing. So what will be the asset? If you be using it, all right, we call it the recoverable amount. If you will not be using it, we call it the realizable value, all right? So value in use, realizable value, all right? So that is what we are trying to say. So now, the revaluation goes like this. So probably, let's say you have the carrying amount. When I say carrying amount, you know it is the amount that you have taken off all these things. According to the standard says that the carrying amount is an amount by which an asset is represented in the statement of financial position. In the statement of financial position. So that is the carrying amount. So you take the carrying amount, that is the value, and they will revalue it. So revaluation. So revaluation, they will revalue it again. So therefore, the revaluation now becomes the SOFP value if they revalue it at the end of the year. Now, you see what will happen is that there will be some differences in between this place. So assuming this one is 10,000 and you revalue it to 20,000, there is a difference of what? 10,000, is that not it? So that difference is called revaluation surplus, which will go to your OCI, your other comprehensive income. So please watch what we are doing. We found a figure how we treat it, how it goes to P&L. We found how figures go to the SOFP, and there is another introduction called OCI. So when we give you a case, that is where you are picking your figures to. It's very, very important. All right. Okay. As for corporate reporting, they will tell you to express your understanding. You may probably not be. So in terms of explaining it, that is how you do. All right. So that is it, revaluation. So, and the thing is that the standard says that if you revalue an asset in a class, so you see there is a PPE. PPE is property, plant, and equipment. If you revalue the equipment, the standard says that you must also revalue the property and the plant. You cannot revalue one and leave the others. All of them must be revalued. All right. So when an asset in a class is revalued, all the assets in the class must also be revalued. All right. So that is what the standard says. So please, these are the exam points. You have to be noting them. You see, those words that we are saying, they are not the figures. So in corporate reporting, that is where they are interested in. All right. Now, so that is that. And you see here, so when there is a revaluation, a positive increase, like you saw here, so we have 10,000, it moved to 20, we revalued it to 20,000. The difference of 10,000 is treated as what we call revaluation surplus, and it will go to the OCI. All right, so that is what the standard says. Increase in the value will take the revaluation surplus to OCI. Now, my question to you is that what if we have 10,000 and it comes down to 8,000? It is a loss of 2,000. Where will it go? Where will it go? So the standard says that.
Yeah, no.
Please come again. Hello?
She said P&L.
Yes, it will go to the P&L, but it will go to a P&L on a condition. It only goes to the P&L when the asset has never been revalued to get a positive before. So that is what it means. When there is no opening balance of the same asset, or we are talking about the class here, in the OCI. So what do we mean? So assuming that this asset that you see, so let's say the first one, the carrying amount was 10,000. Somewhere in June, it was revalued to 20,000. And by the end of the year, December, that same asset was revalued to, let's say, what do we call it? Let me use 15,000. So you see that in between here, there is a revaluation surplus of 10,000, which I said will go to the OCI because it's a positive revaluation. See. Then you see over here, it is a loss of 5,000. You cannot take this 5,000 to the P&L directly because that same asset has been revalued before with an amount seated in the OCI. Or let's say in January, let's say you have 2 years. So 2018, and there is a balance brought down of your revaluation surplus account or your OCI account of, so this asset, we are in 2018, but prior to 2018, there is a balance of this asset which was revalued, and the balance is like 10,000. Now, it was an asset that was revalued. The same asset in this year, so these figures are for 2017. So in this year, you check the asset carrying amount at the beginning is, let's say, the 10,000, and please not this 10,000. No, this is a revaluation surplus account, but I'm talking about the asset itself. It's having the value of 10,000, and it is now revalued to 20,000. Let's say, let me use 8,000. So you see that the revaluation in 2018 will be a loss of 2,000. So when you have such cases where these losses, so you see that asset has been revalued before and it has an opening balance in the revaluation surplus account. Because of that balance that is over there, you cannot take this one straight to the P&L. You need to first go and offset the loss in the OCI. So this one like this, you have to first pass the 5,000 through the OCI. So it means that you won't get some to go to P&L. Assuming the loss was 15,000, you will pass 5,000 to go and offset the 10,000 in the OCI, and the 10,000 to go and offset this 10,000 in the OCI. Then the balance of 5,000 will rather go to the P&L. Please, have I made sense on this one? Because this one, if PP is coming, they will test this one.
So please, can you go over?
No problem. But I want you to listen carefully. All right, what I'm saying is that a positive change, so positive 10,000 to 20,000, positive increase in the value brought about a revaluation surplus, positive 10,000, it will go to the OCI. If it is a loss, the loss must first be matched with a previous revaluation surplus of the same asset. The same asset. So what I did here was that, you see, this asset, whatever it is, this PPE, has been revalued before, and it has a revaluation surplus of 10,000 in the opening balances. You will see it in your capital surplus or your revaluation surplus account. Now, if you now make a loss, the obvious thing is that losses go to the P&L, but you first have to ask yourself, has that asset had a positive revaluation before? If it has had before, the loss must first go and cancel that before, the profit before, the revaluation positive, surplus before. Any balances will go now to the P&L. Please, is it clear now?
Yes, please.
All right.
Thank
So,
you.
yes, so please take, yes, please.
What about if the previous balance to is a loss?
And you have another loss?
Yes.
Straight to P&L. Because that previous balance that is a loss will be in the P&L. It can't be in the OCI.
Okay. Okay.
Is that okay?
Yes, please.
Because yes, that is what the standard says. Yes, any more question?
So the OCI, the balances that go to the OCI are the gains.
Yes, the gains.
Okay. Thank you very
much. But the losses also go to OCI, depending on the condition that I've given you now.
Okay.
Yes. If there is no such condition, then it goes straight to the P&L.
Thank you very much.
So don't make it an automatic statement that losses go to P&L. Losses go to. If you keep saying that, it will shape how you answer the question. So always say it goes to the P&L only when there is no previous revaluation surplus balance to offset that loss with. All right. So if you keep saying that one that I'm giving you now, in the exams, you know that that is exactly what you have to do. Okay. All right. So that is the thing about the revaluations.
Sir,
yes, please.
Please, so in a situation where, let's say, in the previous year there was a revaluation loss, which goes to the P&L, and then
I've already said that the previous revaluation loss will already be in the P&L. It can't be in the OCI.
Okay,
it can't.
So if that one is in the P&L,
then your loss that you've had this year also goes to the P&L.
I mean, this year you're having a surplus. So would you have to?
What you are telling me is that last year there is a balance of let's say 8,000 loss, which will be in the. See, this one will already be seated in the P&L, so it won't be in the OCI.
Okay.
All right. So don't make it like, oh, there will be a loss in the revaluation surplus account. No. Losses, if they did not have anything to match this loss against previously, it will go directly to the P&L.
Okay.
So there's no way your revaluation surplus will be a loss. For previous years, balance brought down, revaluation loss. It should be in the P&L. Okay. Then this year, if you make a surplus, so because of what your question, I'm tempted to believe you wanted to go and offset the surplus in the P&L, then any balance will now go to the OCI. I'm thinking that is what is in your mind. But please, like I said, this one will already be in the P&L. And so your loss, you go by what this is a surplus that you've had this year. That one will straightly go to the OCI. All right.
Okay. Thank you.
Okay. So that is it for the revaluation. So always check for that. Always check for that. Then I'm going to talk about change in useful life and show you something that happens also. See, these are things that probably you may not be taught in when PPE is being taught. Is people will move fast. But please, the way I'm going with it, I need you to get the key points because we will start dealing with the questions. All right. So change in useful life is something I want us to look at. And I'm going to use an example to deal with that.
Dr. Ansah?
Yes, sir.
The marker, please, let me ask you. The handwriting is too small.
Really? It's not clear or it is too small?
No, it's too small. Somebody was asking whether you are afraid of the wastage of the marker. Yes.
No, because I also used it big and somebody also complained.
Oh, sorry.
Yes. So it can be like this. And
for us.
You see, it has, I'm using 2. So if I come to 3 and I write,
Thank you.
You see how it's like?
Yes, this is like we are in the space. That is good.
So that is why I use the 2. So you want me to keep using the big one?
Yes.
Okay. This is something that I want us to also look at. I'm going to use an example. So you have an asset which costs 10,000. You see the way this one is when I use the marker big. Then useful life. So it's not always a change. It can be a change in the depreciation value. Useful life is 5 years. So this asset was bought on 01/01/2020. Useful life is like this. On 01/01/2022, assets was revalued to 8,000. Please determine the values to be treated in the financial statements. All right, so this is the question. Please, can anyone help us how we go around as at 31st December 2022? Yes, can anyone help us? Let's get something done. For the little that we've done, I want to show you something. Let's get something done. Yes, who is helping? I'll call names. Stephanie. Somebody is trying to talk, but the network is bad.
Hello.
Yes, please.
Hello.
Yes, please.
This one, first and foremost, we have to determine the current amount of the asset.
Yes.
And to determine the current amount of the asset, it was first and foremost acquired on 1st January 2020. From 1st January 2020 to 31st December 2021, that's 1 year.
No, that would be 2 years.
2 years. So we determine accumulated depreciation. Let's take accumulated depreciation. The useful life of the asset is 5. Initially was 5 years. So we determine the 10,000 divided by 5.
And the 2 years.
Yeah.
2020 and 2021. Yes. What will you get?
Yeah. That's 5,000. 2,000 times 4,000. 4,000. So that's 6,000. The current amount will be 6,000.
And this one is revalued to
8,000. So revaluation gain is 2,000. Or revaluation surplus.
Where would the figures go? This one will go where?
OCI. OCI.
But are you done?
Yes, please.
Okay. Oh. So is that all? I want to all the financial statements. What will go to P&L? What will go to SOFP? I mean, where are the figures? You just giving me OCI.
Okay, so the depreciation will go to P&L.
Which depreciation?
The accumulated depreciation will go to P&L. Then the revaluation, the current revaluation will go to
doesn't go to P&L. Don't make that
depreciation.
I even showed you in what I did when I started cost model, which part goes to P&L. So
yeah,
please be careful.
So the current revaluation of 8,000 will go to statement of financial position.
That is also not true. Yes, who else? The revaluation was done on 01/01/2022. If you are supposed to prepare this to this year, you need to calculate the depreciation on this, which should give you like 8,000. Remaining life, you've done 2 years here, so remaining life will be 3 years. Please find me the depreciation. The depreciation for 2022. Yes, what do you get?
2666.67.
666.67.
Yes, please.
So let's make it 2667. Okay. Let's round it up. 2667. All right. So it means that our CA to the SOFP will be how much?
5333.
Please, is this difficult? You have to use the things that we said. Like I keep telling you, when we start, make the important notes because you'll be going to apply them to solve the questions. And if you miss it over there, you will never understand the figures. And so please, we will be doing standards. As for standards, we will be doing. When we start with the explanation step by step, I need you guys to make notes, key notes that you will be needing. If you have to copy everything, you can copy everything. So that when we get to the application, you see, ICA is developed into 3 parts. We have the level 1, which is called knowledge. Level 2, application. Level 3, professional. And so at the level 3, we know that you've gone through the knowledge and the application, and here you are coming to explain to us how it is done. All right. So in your questions, it is always like explain, how would this? It's not like the way it is asked in the level 2. So here you exhibit understanding and you present it in a professional manner. So that is something you have to take note of. All right. So this now will be towards P&L, true of us. And this now will be to the SOFP. But there is something I need to teach you here. So in questions, they may say that companies make transfers to retain earnings or transfer of excess depreciation to retain earnings. If you see this statement in the question, or they make transfers to retain earnings, make transfer of unrealized amounts to retain earnings, make transfer to retain earnings, make transfer of excess depreciation to retain earnings. You have to take note of that. Please, without the revaluation happening, what was the depreciation per year? 2,000, true or false? True or false?
It's true.
True.
You mind me? True. All right. To get what we had for 4,000. Because the revaluation happened, how much is now the depreciation per year? 2,667. Have you seen it? So there is an excess of depreciation happening just because the asset was revaluated. And so this difference between the two depreciation, which is 667, is what the statement company make transfers, blah, 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 refers to. So it means that you will have to take this 667 from this value in the revaluation surplus and transfer it to the retained earnings. So you see, and these things are, they are pure things you should understand. It's not like, oh, I need to do Babadi or something. Watch this. You said you have gotten a revaluation surplus when you're 2,000. But because of that revaluation surplus, an expense that you were treating 2,000 every year has increased to 2,667. So how profit are you making here? How much profit technically? It means that I need to take the 667 out of the profit I seemingly had. This one is an unrealized profit. It is not a profit that you have had physical because you traded. It is a profit you've had because you revaluated something. That is why it is in the OCI. As it means that it was a proper profit you get, a realized profit, it will be in the P&L. All right, the surplus, it will be in the P&L. But because you have not realized it, it is not physical for you to touch that this is the profit. I can count this profit. That is why we take it to the OCI. All right. So that is what the OCI is meant for. Now, the difference, which is the 667, we need to reduce the seemingly profit that we have had by the difference. If the company says they make transfer, please emphasis, if you see it in the question. If you don't see it in the question, don't go and do it. All right. Now, what you do is that, and so therefore, the money that is in the revaluation surplus, which is 2,000, has to be reduced by this 667. And that 67 will also go to what we call the retained earning. So in terms of doing the double entry, you will say debit revaluation or OCI with 667 and credit retained earnings 667. 667 is the difference. All right. Please, have I made sense here? Hello? Hello, class.
Sir Tom.
Yes, please.
Yes.
I saw you putting down 2,000 minus 666. That value, where does it go?
Oh, it will stay in the revaluation surplus. You just took part of it. So the balance is where it is.
Are you going to pass journal?
No. The journal is what you've passed. This one is here. This is the journal. The 667, this one is already in the OCI. You are lessing this one by 667. So it means that what you will be in your OCI will be 2,000 less 667. Please, are you getting what I mean? Hello.
All right.
Hello, sir. Tom.
So what I'm just saying is that, please, can somebody list it for me? Let's get the value.
You have 1333.
Exactly. So what I'm saying is that in your OCI at the end of the day, you have one. You said it's what? 1,333. Yes, that is what you have in your OCI. Your revaluation surplus actually will be the 133. It's not like you are going to pass another journal for this 133. You just took 667 off, so the balance is still where it is.
Hello, sir.
Yes, please.
There's 667. Why are we leaving the 2,000? The depreciation.
Which
when
it is not doing a depreciation. It's your normal depreciation. This whole depreciation is going to P&L. We've stated it here. It's not like you are lessening this 67 from the depreciation. Please, I didn't say that. And so therefore,
the first depreciation for
this
2020 and 2021. That was 2,000.
No, it was 1 year that was 2,000.
Yes.
Not 2020 and 2021.
Okay, each year we have a depreciation of 2,000.
Yes.
Okay, when we go to 2022, we revalue the asset.
Exactly.
And then we had a depreciation of 2,667.
Yes.
I was thinking that if we want the transfer now, the transfer of the excess depreciation, it would have been the 2,667 minus that's 2,000.
Yes, that is what we did.
But when you now pass the 667 alone, I mean the down, when you wrote after the decision, when you wrote RS 2,000 minus only the 667, that place, yes, that place.
It's not referring to this 2,000.
Okay.
I think I've done the RS here and the RS here, so you know that this is what we are referring to.
Okay.
So it is not this 2,000. It is the revaluation surplus 2,000.
Okay. Okay. All right. Thank you.
Yes. Any other question? All right, so that is what you do if the standard tells you to transfer. That if it doesn't, you end your this thing here. That you won't cater for anything here. You just end everything here. You take this one to your SOFP. You take this one to your OCI. Take this one to your P&L. All right, so that is that. Okay, so that sums up PP IAS 16. The last thing I want to show you will be the disposer. The disposer. In fact, the disposer is beyond. I mean, it's below this level, but I just want to show you for office purposes. All right. So you have the same. If you have an asset that has been disposed, you see in the lower level, we lend T accounts. And you have the asset, which is the cost. Then you have another T account, which is called the accumulated depreciation. So cost, you do what? You debit the cost with cash or bank if you bought it, let's say 10,000. Let's assume that this asset has lasted for 3 years. for which depreciation useful life was like 5 years, meaning that the accumulated depreciation that you will be having will be, what do you call it? Will be how much? 6,000. True, it's true, right? 6,000. So this 6,000 is made up of the depreciation that happened each year, accumulated 6,000. So that is what you have. If you now sell this particular asset, you need to open what we call a disposal account. All right. Now, if I sell the asset, so let's say, let me open a cash book. So let's say by the time I bought the asset, what did I do? I credited here 10,000. These things, this accumulated depreciation will go to the depreciations year on year. So depreciation, what you do is that you have depreciation accounts for these values. So it will be how much? 2,000 each year. So depreciation, you debit here, you credit here. So that is what you've done for 3 years. That has given you this value. If you now sell this asset, so let's say the asset is now sold for, let's say, 8,000 cedis. All right. What do you now do? You need to, the asset is no more in your company. You sold it. So the asset should not exist in your company anymore. So what you do is that you come here and do disposal account and write off the asset so that it will no more exist. You've credited here. What you do is that you come here to the asset and debit 10,000. All right, so that it will no more exist. Since the asset is leaving, the accumulated depreciation for the asset should also leave. So the accum dep will also go to disposal because the asset is no more in your company. You shouldn't have figures for it. So you come here, accum dep 6,000. So that it will leave your books. Don't forget, this one too is gone because the year on year comes here. Now that you sold the thing for 8,000, what are you going to do? You are going to receive cash. So whoever bought it, you put the person's name here. So disposal, you have 8,000 cash that you are receiving. And what do? You've debited here, you need to credit here, cash, 8,000. So at the end of the day, you see here that here will be 14,000. It is not balancing here. And this one was what we call the gain on disposal, which is 4,000. So you have your 14,000. So the question is that where will be the corresponding entry of this 4,000? It's a gain. So the corresponding entry of this 4,000 will go to what we call other income in the P&L. All right. And in financial reporting, this other income that you do after gross profit doesn't come in again. So learn how P&L structure looks like. There's nothing like other income these days. So you put it in what we call the investment income. All right. Now, column. That column is where you do it. This is the new structure for P&L. Please, I'm going to a new body. Do you have a question here? Do you have a question here?
Please hold on for just a minute.
All right. I just wanted to show you the reporting framework for P&L presentation. So that at this level, I mean, you see, the truth is that you are now professionals. You'll be preparing accounts for your company according to the standards. So IAS1 gives presentation of how your P&L should look like. So that is exactly what you do. You don't do any other thing from that. All right.